pili yung kurso, mauna nila ang isa analysis sa subject line ang yaw. Saktan. Wala pa rin ako nakatulog. Alas dos na. Lord, nabaki ko, please. Sama na ko. Ay, kabalo na ko. Okay, YouTube University, here we go. Mami ko, please.
Meet Francis Equipment Company, a company closing its books every December 31. But at the end of year 2025, they did something unusual. They kept their cash book open and recorded January 2026 transactions as if they happened in December. Why? Well, to make their financial position look stronger, for better credit and business appeal. For the details, they recorded over 2.7 million in January cash receipts and more than 1.3 million in disbursements as December entries. But these violate the proper accounting rules, especially the cut-off principle. The inventory count was done right, but the cash, receivables, and the payables were distorted. So our task? Well, let us fix the books with proper adjusting entries, as well as let us measure how much better they made their financials appear by comparing the working capital and the current ratio before and after corrections. So for today's video, join me as we dive into the adjustments and uncover the truth behind the numbers.
Financial statement should accurately reflect a company's financial position. However, some businesses make their finances healthier than they really are. Francis Equipment Co. had kept their cash book open beyond December 31, 2025, falsely inflating liquidity and misstating revenue amounting to 2,738,400 pesos and expenses of 1,347,000. This presents a stronger financial position for credit evaluation. Now, this is a serious problem. The company had violates the ethical and regulatory concern every business must adhere to by manipulating financial statements, misleading creditors, and violates the faithful representation under the IFRS and GAAP, preaching the principles like periodicity and matching, or should I simply say the window dressing. This is a fraudulent reporting, or famously known as cooking the books. In addition, the company had violations and managerial risk. The company will suffer or subject to reputational damage and increasing the audit risk. While companies may seek short-term credit benefits, this jeopardizes the long-term trust, increasing audit risk and potential penalties.
At this juncture, let's talk about analysis. First, we're going to tackle about the accounting principles involved, such as revenue recognition principle. Only revenues earned as of December 31 must be recorded. Second, matching principle. Expenses must be recorded in the same period with the associated revenue. Third, cut-off procedure. Transaction must be recorded in a proper period, or what we also know as periodicity concept. Fourth, faithful representation and consistency in financial reporting or compromise. Lastly, ethical and professional conduct. Accountants are required to uphold integrity, objectivity, and professional behavior. The second part is financial impact towards the following account. First, cash, originally reported as of December 31, 2,340,000. Less cash receipts in January wrongly added, 2,738,400. Add January disbursement wrongly subtracted, 1,047,000, which equals to 948,600, the correct cash balance as of December 31. We can observe that the previously reported cash balance is overstated. For account receivable originally recorded, 2,520,000, plus collection recorded in error, 1,058,400, plus the discount, 21,600, which equal to 3,600,000, the correct AR. We can reflect that reported AR previously is understated. For accounts payable originally recorded as 2,700,000, plus January disbursement erroneously recorded in December, 1,347,000, plus discount, 15,000, which equals to 4,062,000, the correct accounts payable. We can observe that the reported AP previously is understated. Now let's take a look to the following. This is our journal entries. First, we have here cash sales 1,680,000 that should be recognized in January, so we reverse it. Second, collection in account 1,058,400 with discount 21,600 that should be recorded still in January. Thus, we need to reverse it. And the lastly, reverse January disbursement 1,047,000 with 15,000 discount to correct the error or misstatement recorded previously. Now let's proceed to the financial impact ratio. For the reported one and the adjusted one. For the reported one, the working capital is 5,328,000 from the total asset less total liabilities, and the current ratio is 2.5. From total asset 8,880,000 divided by the total liabilities 3,552,000. On the other hand, the adjusted working capital is 3,654,600 from the total asset less total liabilities, while the adjusted current ratio is 1.74 from total asset 8,568,600 divided by the total liabilities 4,914,000. So here we can observe that the current ratio for the adjustment is lesser compared to the previously reported. Moreover, I'm going to talk about the implication of the differences between the working capital and the current ratio between the reported one and the adjusted one. The implication of the earnings entry for the working capital is overstated by 1,678,400, and the current ratio is inflated from 1.74, which is the actual one, to 2.5 that is stated. This is important information because creditors use these ratios to assess liquidity and solvency of the company. Overstating cash and understating liabilities creates a false sense of financial health, potentially linked to unjustified borrowing or credit terms, just like what happened to the company we discussed earlier. This may expose the company to legal, audit, or reputational risk.
Based on the issues identified in the analysis, it is imperative that Francis Equipment Company take immediate steps to correct the accounting irregularities and strengthen its ethical and financial reporting practices. The following recommendations outline both corrective and preventive measures to ensure compliance with accounting standards and uphold the integrity of the company's financial statements. First and foremost, the company must correct the cut-off error by making the necessary adjusting journal entries to ensure that all cash receipts and disbursements are recorded in their proper accounting period. This includes reversing any January transactions that were inappropriately backdated to December. Second, the company must adhere strictly to the matching principle and faithful representation as mandated by both IFRS and GAAP to uphold the periodicity assumption and maintain the credibility of its financial reports. Attempting to present an artificial favorable financial position through window dressing, in this case inflating year-end cash and reducing liabilities, misleads stakeholders and constitutes a serious breach of professional and ethical standards. Third, Francis Company should transparently disclose any material post-period events in the notes to the financial statements, rather than manipulating the financial cutoff. This practice not only ensures compliance with accounting standards, but also builds trust with creditors, investors, and auditors. And lastly, to prevent recurrence, the company should educate its accounting staff on proper cutoff procedures, ethical financial reporting, and the consequences of misrepresentation. Management must also implement stricter internal controls, especially during year-end closing, to safeguard the accuracy and integrity of financial information. By correcting the current misstatements and strengthening its accounting practices, Francis Equipment Company can preserve the integrity of its financial reporting and avoid potential irregularity sanctions, audit qualifications, and long-term reputational damage. This approach supports sustainable financial management and reinforces accountability across all levels of the organization.
In this conclusion, we will summarize the key takeaways and highlight the essential accounting principles that should guide responsible and accurate financial reporting. Let's recap the critical lessons from this case of Francis Equipment Corporation. First, cut-off procedures are not optional. They are essential. Recording January cash receipts and disbursements in December violates the matching principle and the accrual basis of accounting. It results in misstated financial statements, like overstated cash, understated liabilities, and a distorted financial health. Remember, revenues and expenses must be recorded in the period they occur, not when it's most convenient. Second, financial ratios can be manipulated by misclassification. Holding the cash book open increased Francis Co.'s working capital from 3.6 M to 5.3 million and the current ratio from 1.74 to 2.50. That might impress investors or creditors, but it's not real. It's a short-term illusion that could lead to long-term consequences. Third is ethical responsibility is part of accounting. This case highlights how easily financial data can be skewed, but as accountants, we are bound by our professional code of ethics. Integrity, objectivity, and faithful representation are not just buzzwords. They're the foundation of public trust in financial reporting. Fourth, understanding the periodic system, inventory system helps identify where manipulation is possible. So in this case, inventory was correctly counted, but the problem came from the cash transactions. Knowing how each component of the financial statements interacts helps you spot red flags early. Fifth is journal entries tell the story and the truth. By reversing the premature entries, we saw how quickly numbers shift. Always double-check entries around cutoff dates, especially cash and receivables. And that's it. We balanced the book, reversed the entries, and uncovered the truth behind a too good to be true cash balance. Remember, in accounting, it's not just about making things add up. It's about making things make sense. Numbers don't lie, but sometimes the way we record them can. So, always apply the right principles, stay ethical, and follow the proper cut-off procedures because kahit gaano pa ka-clever ang entries mo, walang lusot sa audit. And that's it. Thank you for listening.
Ay, salamat. Kasabot na dyan ko. Pakasar na ko. Sa piano. Thank you.